One of the core arguments for owning passive funds is that most fund managers cannot consistently identify the shares that are going to do well. Rather than trying to pick the best individual shares, passive funds aim to replicate the performance of an entire index. After subtracting fees, investors will receive a slightly lower return than the index that the fund is tracking. Passive funds come in two forms: index funds and exchange-traded funds, ETFs. The core difference is that unlike index funds, ETFs can be traded throughout the day on the stock market, much like individual shares. For long-term investors, the difference is not that important. Among the advantages are that passive funds offer investors cheap, simple and effective exposure to global stock markets. A passive fund tracking the US or UK market can be bought for less than 0.1% a year, which is £10 on a £10,000 investment. They also give investors direct exposure to themes such as cloud computing, robotics and automation, the adoption of electric cars and clean energy. The main disadvantage is that by definition, a passive fund will not outperform the market. Active fund managers may outperform, but of course there are no guarantees that they will. A passive fund will also not protect capital in a market downturn. They will fall in line with the market. Active funds can take measures to protect capital when stock markets fall, such as moving into cash or buying more defensive shares.